So today we set up something a little different with Hedge Legal, and Poseidon Retsinus is the CEO and founder. I've spoken to him a bunch of times now over the last month. He does something that I think we all deal with, which is really interesting, which is really getting into the weeds of negotiating prime brokerage, is the repos, custody agreements, etc. And I have some great experience with that and a lot of clients. So I'm going to throw it over to him, and he's going to give you a presentation on what I think is a real valuable item for all of us in the hedge fund world. So Poseidon, it's all yours.
Thanks, Joe. Thank you for that wonderful introduction. So as Joe mentioned, my name is Poseidon Retsinus. I'm the founder of Hedge Legal. We're a firm that's dedicated to providing hedge fund managers with a comprehensive and high-quality solution for onboarding and negotiation with prime brokers and other trading counterparties. So as Joe mentioned, ISDA, futures, repo, custody, really across the gambit of trading agreements. I have over 12 years of experience in the hedge fund industry. I was formerly an associate at Clifford Chance, specializing in derivatives, and more recently, I was heading up counterparty negotiation and onboarding with prime brokers at InnoCap, one of the world's largest hedge fund managed account platforms, managing about $7 billion under management. So in that time, I worked with a number of managers, probably around 70 or so hedge fund managers across all major strategies and asset classes, and worked with many of the main, well, pretty much all of the main prime brokers and a lot of the counterparties. So the first two slides kind of go through that. Now moving into the content here, so dealing with a crowd that's quite sophisticated and knowledgeable in this area. So the first part of the presentation, I really just go through some of the high level stuff. What is prime brokerage? What services do PBs provide? Who needs a prime broker? How do prime brokers make money? And then in the second part of the presentation, I'm going to dig in detail into some of the most important legal terms and ways you should be thinking of your prime brokerage agreement and that relationship. So starting out with the first item, what is prime brokerage? So the term prime brokerage can often be used loosely, and it can include a lot of things. So the classic case is the equity prime brokerage for the long short managers or market neutral trading equities. Fixed income prime brokerage is another important category. Synthetic prime brokerage, where equity swaps are used via an ISDA CSA, and this is often wrapped into the prime brokerage margining, the PB agreement, or into the margining methodology. That's an area that's we've been seeing increasing growth and usage over the last 5 or more years. And derivatives intermediation, so FX prime brokerage or interest rate swap prime brokerage. This presentation will mostly be looking at equity prime brokerage. If there are questions and we want to dig into any other types, happy to take those afterwards. So what services do prime brokers provide? The first and the most obvious is they custody the assets and they provide clearing and settlement services. Secondly, they shorts. They provide locates on the shorts. They lend stocks to hedge funds so that they can go short. They lend financing. They lend hedge funds money so that leverage can be obtained. Those are the three, I call it the three main areas. And then there's a number of other services that come along with that and can be important depending on the strategy and manager's needs. So research, corporate access, dealing with corporate actions, reporting on the account, technology services, analytical tools, say, margin replicating tools, or other, technology for trade execution. Trade execution itself is not really a prime brokerage service, although all of the main prime brokers have large execution desks, and to the extent that a manager is using their execution desk, that's helpful and something that they like for their overall business. Capital introduction, and finally consulting. The bigger bulge bracket primes have quite sophisticated hedge fund consulting groups, which can be quite helpful to managers across many aspects of running their business. So who needs a prime broker? Well, everybody on this call, I'm assuming, and hedge funds, leverage, shorts, doing swaps and synthetics, or leveraging fixed income using repos. Clearly, long-only managers that don't use leverage do not need a prime broker. How do the prime brokers make money? So the main elements are the financing. We have to remember these are banks, so they make money by lending money, and certainly they like clients that run debit balances. Shorts, the fees that they'll charge on the shorts are also a significant source of revenue, particularly for managers that are operating in a more hard-to-borrow space where they can charge higher fees on those stock loans. And execution, so the execution portion of it, thinking, quant funds are great for this. PBs get pretty excited when they hear about a quant fund that's equity market neutral, and using a lot of leverage. So this is also an important element for them. But the revenue is not. I don't think it's not the only story. It's not the only factor to them. There's an internal cost of capital to the prime brokers and the balance sheet impact that also has to be taken into account. So, particularly, they'll look for liquid securities are better than illiquids on the balance sheet impact, and not to mention how is the portfolio set up? Is it leaning too long or too short? That can also be a negative factor. And lastly, the internalization. So how can the prime broker use the securities of one client to rehypothecate them or lend them to another client? So the more that they can cross-pollinate or use securities of one of their clients for the activities of one of their other clients, that's also beneficial, and that's helpful to them from an overall business perspective. So getting to the legal. How do the legal documents work? So the agreement is typically between the fund and the prime broker. There's no industry standard in prime brokerage. Every PB has their own bespoke form. There's common threads that run through all of them, but they're all quite different. So that adds a certain level of complexity when you're moving from one PB to another to be able to compare what's in both of these agreements. So here, this to me is the most important way to look at the prime brokerage agreement from a high level. And I think it goes back to what is a manager looking for from a prime broker? So we talked about the services, we talked about and how the PBs will make money. But in terms of the services, so your PB, a manager wants services. They want the service done at an effective rate, so the fees, and they also want stability. You need stability into the future, particularly if you're single prime, even if you're multi-prime, but you want to make sure and you want to know that this relationship is stable and it can't be pulled away from you quickly. So these three elements are the ones that I look to see how have they been set up, how do they align, and how do they link with one another. So starting from the left-hand side, the fees, the financing, and the term. So the financing, it's very important to know what the financing rates will be and have those locked in for a certain period of time. So the term, the bottom bullet there, term commitment, margin lockup agreement. It's called many different things, but this is really to tie in, for one, what will the financing be and what will the term of that financing be? So after how many days of notice can your prime broker change those fees? 30, 60, 90, up to 180 days are probably where things will land. I would say for the most part, things will usually play between the 30 and 90-day range. These fees will cover the shorts as well. And on the fee side, some attention should be taken also to see if the prime broker is going to be charging you any given or clearing fees. So where I've seen this, if you're not doing a lot of execution with your PB, there'll be more of a tendency for them to charge given fees when you've executed away and a trade or a security is coming to them. So it's important to lay that out, to have the discussion with your PB around term. I think more and more, if you ask for term, you can get it, and you can get it at 30 days without moving the benchmark on your financing. So what I mean by that is, so let's say your financing is at overnight plus a spread. If you move it to a 30-day term, the PB will not move that benchmark to a 1 month rate plus the spread. If you try and go out past that to 60 or 90 days, then they'll have a tendency to want to move out the benchmark to the 2 month or the 3 month rate to be able to match to match their financing and the way that they're funding their business. So, but I think, as I said, I think if you don't have one, it's always worth having the conversation. And depending on your size and the importance of your business, that prime broker, that's something that can be attained. The second element there is margin. This is really the the same, the other side to the same coin, meaning like if you're financing without a term commitment, your financing is done at an overnight rate. So the prime broker can effectively pull financing from you on an overnight basis. If you've locked in a term, then they need to notify you, let's say 30 days or more in advance. So the margin is really the other side to the same coin, because, I'll go back. So if you're financing and borrowing, well, you're obviously going to have a minimum margin requirement. So let's say you may be at gross 100 million, and let's say you've left 50 million of cash or of equity in the account. So you're borrowing another 50 million, let's call it just a long scenario. So your margin requirement there, let's say it's at 50%, which would be outlandish. That would be way too high. But the margin, whatever the margin rate is that you're paying, you want to have some, you want to know how that's being calculated, and you also want to have some comfort that won't change very quickly. Because if it does, if the margin spikes, then you're in the same situation as them pulling the financing from you, because you'll need to liquidate positions. So how is the margining determined? What is the methodology? The lockup agreement or term commitment will usually spell that out in some level of detail. And then again, what is the timing? How many days before the prime broker can change that on you? That should align with the term under the term commitment, the same amount of time that you have there. The other thing you want to think about with margin is, are you cross margining this to other products? If you're trading in cash and synthetically, then it's certainly something you want to consider and look at how that portfolio would look margined together and wrapped together, so that you can assess if it's worthwhile to cross margin. When you do cross margin, there's some other legal and credit considerations to take into account, because if you're doing this in a silo, so you have your prime brokerage agreement on one hand, you have your ISDA CSA on the other hand for your synthetics. If this is being done in a siloed approach, usually the broker-dealer entity on the prime side is not the same as the ISDA counterparty. So the ISDA counterparty has a better credit quality than the prime broker does. So once you've cross-margined this, the cross-margining will take place at the level of the prime brokerage entity. That entity will have control and security over the assets. So in an insolvency scenario, you're basically getting drawn into that prime broker's insolvency, whereas in a siloed approach, your equity swaps will be collateralized separately with what's probably a better credit entity and may not be dragged into the same insolvency. So that's something to consider. Does the benefit of cross margining outweigh the potential credit risks? Okay, next item over is termination. There's two ways to think of termination. One is a forced termination, so where the fund or the manager has done something wrong and it leads to an event of default. And the other scenario is a termination without cause, meaning nothing has gone wrong, but the prime broker just wants out of the relationship. The timing for termination without cause should match the timing of the term commitment and the margining of the timing of the margining. So this is what I was coming back to initially, talking about these three pillars. All of these three timings should be aligned, because if one of them isn't, then the other ones are basically not good to you, because those are the three main ways that a PB will get out of a relationship or force you out of the relationship if they don't want to be in it. without you having done anything wrong. Now, if something's gone wrong, something's fundamentally wrong with the fund, that's where the events of default come into play. So these are the events that the prime brokers will put into the agreement to give them the right to liquidate the account. So, and why? So I want to take a slight step back. Why are these events of default important? So, number one, they can liquidate the account. Secondly, and this is something that's often not thought about as much, but it's not just about liquidating the account and forcing a liquidation, which is obviously bad enough as it is. But the second thing is that most of your other trading agreements will have cross default provisions. So as soon as you've triggered an event of default, not even been liquidated. So just having triggered an event of default under one agreement can give rise to defaults under other agreements. So the events of default are really, it can really lead to the death of a hedge fund in a very significant way. So I'm very careful about events of default, limiting them as greatly as possible. So before we talk about what we do to limit them, let's maybe just think about what are the typical events of default. Number one, failure to pay. The fund hasn't paid or has missed a margin call. Another one, cross default, we just talked about. Insolvency of the fund or an insolvency petition being filed against the fund. A misrepresentation, a material misrepresentation that's been made. Things about regulatory status of the fund or of the fund manager. Reputational risk event of default, meaning legal charges against key persons of the fund or of the investment manager. A revocation or lack of authority of the investment manager to act. Change of financial condition or deterioration of financial condition of the fund, or NAV triggers if it's spelled out more clearly. A failure of the fund to deliver information, the monthly NAV report, the audited financial statements within the timelines that are specified. So all of these are some of the typical events of default that will get thrown in there. So first thing we need to think about is we want to limit these events of default as much as possible, and we want to limit the discretion of the prime broker in determining if these things have occurred. So a very simple example of this is the failure or the deterioration of the financial condition. A lot of the standard prime brokerage agreements will have a clause in there saying that there's been it's an event of default if there's been a material adverse change in the financial condition of the fund. And this is determined at their sole discretion. So that could really mean a lot of things. And since that's sole discretion, it's extremely dangerous. This provision gets struck completely. This is something that just comes out. If you ask to remove it, they will remove it. It's completely unreasonable. If they're really concerned about financial condition, then you may consider as a fallback NAV decline triggers. Although even at that, they shouldn't be needed, but a NAV decline trigger, similar to what's in all of the ISDAs, that would be a more appropriate condition. Usually you can get away with none of that in a PB agreement. If you're getting a term commitment, which will usually be a separate document, so your prime brokerage agreement will be one document, and then there'll be a separate document outlining if you're getting a lockup or a term commitment. Usually in the lockup and term commitment, they'll ask for and insist on having some NAV decline triggers because they're committing to themselves to a longer period of time. So limiting the discretion, number one. Secondly, you want to include cure periods for operational errors and carve-outs. So for a failure to pay or you're missing a margin call, you absolutely have to include wording that provides for a carve-out if there's been an administrative or operational error, meaning the money was actually there, but it didn't get sent, be it there was an error on the manager's end or somewhere along the line, it maybe went to the wrong account. And then there's a remedy period for that. So that's crucial. Another type of cure period you're going to want to look to add is to the extent that you're required to deliver fund information, so the monthly NAV report or audited financials. If those don't get there on time, there should be a cure period where the prime broker needs to tell you, hey, we didn't get the monthly NAV report, can you send it to us? And you should have at least 2 business days to remedy that. Next point I wanted to talk about is notification requirement before default remedies are exercised. So in all of the standard prime brokerage agreements, the first draft that comes through, there will be no requirement for the prime broker to notify you that they're putting you into default and that they're starting to liquidate your assets. So this is a must-have. They must notify you before, or at least concurrently when they're going to start doing this. So this is really like a last-ditch effort that if they put you into default and they're going to start liquidating, they at least owe you a phone call to tell you what's happening. One, you may be able to do something to mitigate the impact of that liquidation, or you may be able to prevent it altogether. But it's a much better scenario than just finding out at the end of the day or a couple hours later that the portfolio's been completely liquidated. The next point that you want to get in there is a fish or cut bait provision or a waiver. What this means is once an event of default has occurred, the prime broker should act on it within a specified time period, let's say 30 or 60 days. If they haven't acted on that event of default within 30 or 60 days, then they can no longer act on it. It ceases to be an event which can trigger a default. This is really important because the way that all the documentation is structured is that if an event of default occurs today, the PB does nothing about it, doesn't put you into default. There could be something a few months down the road, let's call it market stress, or they've fallen out of favor with you. They could actually trigger an event of default that occurred a few months back. They could trigger it later down the road and put the fund into default. So it's crucial to have this fish or cut bait wording added into your agreement. Okay, so we've been through at a high level.
Poseidon?
Yeah.
It's
yes.
Joe. Yeah, I've always find that one a very interesting and important term. In your experience with that fish and cut bait provision, how often do they acknowledge and put that into the document when asked? And do you find that most people have that in their document, or do they need to go back really and take a look at that? Like historically, has that been part of the, especially in the category of older documents, or maybe somebody did a PP agreement 8 years ago, was that common practice to have that in there even back then?
That's a great question. So was it common back then? I think it's becoming more common. I think it's becoming more acceptable. As a general matter, I think PBs are a little bit more open to negotiation now than they were in the past. But there's a really important point here that I haven't brought up, but it ties in well to this question that you've raised. Is this is the terms that, so not all hedge funds are made equal, or not all hedge funds represent the same business to their prime broker. So your ability to negotiate some of these terms will depend on your size, on what you represent as a business to them. So that being said, I still think that if they're willing to do business with you, you should be able to get a fish or cut bait provision. Will it be 30 days or will it be a 90-day provision? That becomes a factor. I've heard it from many of the PBs. They'll accept this, but they want it to be out to 90 days so that they have a lot of time to think about it and to consider it. So I do think that it's something that is certainly reasonable. In this, it's something that's completely reasonable to ask for, and I don't see how any prime broker can really defend the position that they should not give you, they should not agree to this on, full stop. So I think it's just a matter of how much time.
Got it. Thanks.
You're welcome. Same thing goes with a lot of the points that I made on the overall, like the administrative or operational error carve out. That's something that everybody should get. The same thing on some of these cure periods. That's something that everybody should get. Removing the material adverse change clause. That's something that everybody should get. So those things are kind of, to me, those are market standard and are achievable by all clients. Okay, so I'm gonna carry on unless sorry, before I go to the next section, does anyone on the call, I don't know, Joe, if they can ask questions, but does anyone have a question on this?
Yeah, if anybody does, please submit it through the webinar questions portal that you have in your little navigation screen that comes up. But I don't see any currently. I'll keep an eye on it and interrupt if I see any come through.
Okay, good. All right, so I'm gonna move on. What are the other terms that are in the agreement? There are many other terms that are important. I tried to pull out some of the most important ones. One element is the insolvency of the prime broker. If the PB's gone insolvent, I'd like to include some set-off rights for the fund so that they can basically set off obligations that are owed between the fund and the prime broker, it limits some of the risk of being caught into a long insolvency. Now, there's been some recent legislation changes in the United States regarding the application of this, or some of the government can step in and protect some of these globally systemic important institutions. So it remains to be seen how significant that will be going forward, but I think it's still worth putting in. Liabilities and indemnities. What will the prime broker be liable for? That's the first point. Typically, what they'll do is they'll say that they're only going to be liable for any losses suffered to the extent that they've been grossly negligent, acted with fraud or willful misconduct. So first thing would be to strike the word gross, so that their standard of the liability triggers if it's just negligence. So they don't need to be grossly negligent to be liable. They can just be negligent. So you might ask, what's the difference? The difference is really something that's grossly negligent has to be extremely bad, egregious. It has to be something that was either systemic, something that multiple people made a mistake on, something that really should not have gone unmissed. Whereas simple negligence can be an error, probably just one place along the chain, somebody that should have done something that didn't. So the standard of negligence is much lower. It's easier to prove that. The second point is the indemnity. So the prime brokers will look for an indemnity for the fund for any losses that they've suffered in relation or in connection with the services they provide under the agreement. So first thing would be to try and remove this indemnity full stop. Most of the time probably will not achieve completely removing the indemnity, but then you'll look to water it down. So to water it down, meaning it should only be for direct losses they've suffered, and there should also be carve-outs that they shouldn't be indemnified if something was related to their negligence, fraud, willful misconduct, or if they've in any way breached the agreement. So these provisions are a little bit more legal, technical, but there's changes that should be made to these, from the standards. Next point I have is parent guarantee. This is probably something that, I've only seen the larger hedge funds obtain, but it's a guarantee from the parent of the prime broker, so of the better credit within the group of companies, that would actually guarantee the obligations of the prime broker in the event of an insolvency. So it's worth asking for, but I would say don't be surprised to not get it unless you're a much more influential client. Operational matters, there's quite a few of them, but ones that should be looked at carefully. What's the margin timing? Again, the standard PB agreement that comes in will not have anything specifying what the margin timing is, meaning it'll just say the fund needs to provide margin, as and when requested by the prime broker, or something along those lines, which basically means that you need to always have enough margin there. So the margin timing is important. Put in, if a margin call comes in before 10 a.m., then it needs to be met by close of business. If it's after 10 a.m., then during the next day, maybe by 10 a.m. the next day, or a little bit later if you can get that. But that's a crucial provision to put in on the margin timing. Some of the other things, delivery of NAV statements. When will that be? How many days after month end? Where do other notices get delivered to? Timing for trade files being provided, timings for statements becoming binding once they've been provided to you. You need to look at this just to make sure that you're checking what they're sending you and where they're sending it to you. So that's important. Amendments. The next bucket is amendments, so modifications to the agreement. Again, here the typical starting point for the PB is that they can make amendments to the agreement upon notice to you or upon certain days' notice. This is obviously bad, because if they can unilaterally amend the agreement, it puts everything and all the negotiation that's been done. It really just it just puts a pie in the face of all that. So it's important that either you go for amendments. Amendments need to be agreed in writing, or they have to be absolutely required by law. That can be one carve out or point we'll give in on. But also that if they really insist on being able to make amendments unilaterally, then that should tie in back to what we were talking about with the the termination without cause, and the margin and the financing. So I think the timing there should be aligned. Next thing, assignment. So assignment means the ability of the PB to transfer their this agreement to another entity, meaning all of the rights and obligations under the agreement to another entity. Meaning, if they assign this to somebody else, that the prime broker, that prime broker is no longer a PB. There's going to be it's basically be a new entity that you're going to be facing. So again, here you want to try and get this assignment that you need to approve it in writing, or that you have a certain time period. Or if they're making an assignment to one of their affiliates, there's different permutations here. You can try and say that it would be the same credit quality, or that they're moving all of their clients, as part of this. You don't want to be singled out, and you don't want to get your agreement assigned to a bad entity or a bad affiliate. Last point I'm going to mention, which doesn't show up on the slides here, is limited recourse wording. This is wording that should be included in your PB agreement, but also in any of your other trading agreements. And this is wording that limits the recourse of the prime broker or of the counterparty to the assets of the fund. So you put this there to shield yourself as the manager. You don't want to open yourself up to liability or legal action being taken by a prime broker against you. But also, depending on the legal structure, you may also want to try and protect the investors from potentially ever having, recourse towards them. Okay, so we've been through the main elements, and just a quick conclusion. There is no industry standard. Negotiations are critical because of the PB's discretion, and their standard forms give them a lot of that. It leaves managers vulnerable and unprotected. So I'm going to turn it back over to you, Joe, for to open it up to the audience. Thank you.